In Chapter 8, we're going to talk about accounting for long-term assets. And there are generally three different types of long-term assets. One is plant assets, then there's natural resources, and then there's intangible assets. Most of our focus is going to be on plant assets because that's probably more typical depending on the type of company that you actually have. This first section talks about plant assets, and for a definition, you can see it here in your book. They're tangible assets used in a company's operation that have a useful life of more than one accounting period, or generally speaking, more than 1 year. A lot of times this will be referred to as equipment or fixed assets, but as it says here in your book, this is generally the single largest class of assets that a company will own. So their building, their plant, their factory, their equipment, all of those things are going to make up the majority of their assets. So plant assets have to be used in operations. So it's not like inventory that you're going to sell. This is something that you're using in the operation of your business. So if a company purchases a computer to resell it, it's part of their inventory. If the company purchases the computer to use it in its operations, then it's a plant asset or a fixed asset. Another example would be land that's held for future expansion. That's recorded as a long-term investment. But if the land has the factory on it that's being used in operations, then the land is part of the plant assets. So it has to be used in operations. And then the second important feature is that a plant asset has to have a useful life extending more than one accounting period. And again, usually that accounting period would be a year. So that's why it's different from a current asset like supplies, which are generally consumed within one accounting period. So the accounting for plant assets reflects these two features. Since they're used in operations, we try to match their cost against the revenues that they generate. Also, because their useful life extend over more than one period, our matching of cost and revenues must also extend over several periods. That's why we have to, generally speaking, depreciate plant assets. Now, that's different with land, but with equipment, with buildings, things like that depreciate over time, we have to account for that expense over time and try to match it with the revenue that's being produced in that particular period. So this talks about the four main issues that are involved in accounting for plant assets. First of all, you have to compute the cost of the asset itself, and that is sometimes more difficult than it may seem. Then you have to allocate the cost of the plant asset against the revenues for the periods that they benefit. Also account for any expenditures, such as repairs and improvements to those assets, and then how do you handle disposing of them when you get rid of them. So we're going to talk about how we handle all of those things in the next section. First of all, the cost determination of the plant asset. First of all, a plant asset is recorded at cost when you acquire it. So when you buy a factory for a particular price, you record it at that price. That's what you paid for it. This is consistent with the cost principle in accounting. But what is the cost? The cost includes all normal and reasonable expenditures necessary to get the asset in place and ready for its intended use. So the cost of a factory machine includes the invoice cost less any cash discount, plus the freight to get it there, plus what it might cost to unpack it, to assemble it, to install it, and to test it. So all of those things are part of the cost of the plant asset. So it's not just the invoice amount that you paid for the piece of equipment itself. So to be recorded as part of the cost, the expenditure must be normal, reasonable, and necessary in preparing for its intended use. If an asset is damaged during unpacking, the repairs are not added to its cost. Instead, those repairs would be charged to an expense account. You can read the rest of this in terms of what kind of things may or may not be. Now, land is different. When land is purchased for a building site, its cost includes the amount paid for the land, including real estate commissions, title insurance fees, legal fees, property taxes. Payments for surveying, clearing, grading, and draining the land are also included in the cost of the land, because all of those things are necessary to get it to where it can be used in operations. Other costs might also include government assessments for things like roadways, sewers, sidewalks that are going to have to be put in. Also, they permanently add to the value of the land. That's one of the reasons why we include it in the cost. Sometimes you have demolition, because land purchased as a building site might include a structure that has to be removed. In that case, the total purchase price is charged to the land account, as is the cost of removing the structures. Now, you may actually be able to remove the structures and get some money for some of the stuff that you tear down, and that would be salvaged material, so that reduces the amount of the cost. So they give you an example of Starbucks paying a certain amount of money for cash, to acquire land for a retail store. They had to remove an old service garage, list the cost, those kinds of things. It shows you how to go about calculating the actual cost of the land to Starbucks. So they paid cash of $167, but with all the additional costs, it ends up being $190. Land improvements. Now, land itself is not depreciated because it has an unlimited life. It's not generally used up over time like a building or a piece of equipment. Land improvements like parking lots, driveways, fences, shrubs, lighting systems, they have limited useful lives and they are used up. While the cost of these improvements increase the usefulness of the land, they are charged to a separate land improvement account so that we can depreciate or allocate their cost to the periods that they actually benefit. Building. Building is charged for the cost of purchasing or constructing the building. It explains here all the things that might be included in the building cost, like the brokerage fees and taxes and title fees. It also includes all of those expenditures to get it ready for its intended use. Again, it explains here what some of those costs might be. Now, overhead includes the cost of items like heat and lighting and power and depreciation on machinery used to construct the assets. Cost of construction also include design fees, building permits, insurance during construction. However, costs such as insurance to cover the asset after it is placed in use is not part of the cost of the building. It's an operating expense. So these other costs are included because it's to get the building into the condition it needs to be in to be able to use it to start producing revenue. But the kinds of costs that you have after it's in place could be charged to operating expenses depending on what we're talking about. Machinery and equipment, same thing. All costs normal and necessary to purchase and prepare them for intended use. These are some of the things that might be involved in what the cost of the machinery and equipment would be. So it gives you a couple examples here, and the answer should be in your book as well. Lump sum purchase. Plant assets sometimes are purchased as a group in a single transaction. This transaction is called a lump sum purchase or a group or bulk purchase. When it occurs, we have to allocate the cost of that purchase amongst the different type of assets that have been acquired based on their market values. Now, you generally have to get this by estimating based on an appraisal or by using the tax assessment valuation of those particular assets. So here's another example. If CarMax pays $90,000 to acquire a group of items that includes land improvements, and a building, the $90,000 cost is allocated on the base of these appraised values as shown in the exhibit on the next page. So you would take that $90,000 and you would have to allocate it these appraised values add up to $100,000, but you only paid $90,000. So you'd have to do an allocation to determine how to apply that $90,000 that you paid to those three different items. Also listed on this page are some quick check answers so that you can look at these and then go to page 361 to check your own answers and make sure that you understand this material. All right. Now we're going to talk about depreciation. And depreciation is a very common accounting issue that you have to deal with in almost every company, because almost every company owns something that is being depreciated over time, piece of equipment, building, even a computer, those kinds of things. And it can get complicated in terms of how you go about doing this, but there's some basic principles involved, and then the more you get involved in accounting, you'll probably encounter various types of complications in dealing with this. But when we talk about depreciation, it's the process of allocating the cost of an asset to expense in particular accounting periods. It's not measuring the decline in the asset's market value, because the market value could be declining at a slower rate or a faster rate. But that's not what you're doing. You are allocating the cost to various accounting periods. All right, so these are the different factors that are involved in computing depreciation. The initial cost, what we believe the salvage value to be at the end of its life, and its useful life, meaning how long do we expect to be able to use this particular item. So, as we've already said, the cost of a plant asset consists of everything necessary and reasonable to both acquire it and to prepare it for its intended use. The salvage value is after you've charged the total amount of depreciation. You usually have left a salvage value. Sometimes it's zero. Sometimes, there isn't any salvage value. But often something will have some salvage value to it, or residual value, or they sometimes call it scrap value. So it's an estimate of the asset's value at the end of its benefit period. This is the amount the owner expects to receive from disposing of the asset at the end of the period. So you would take your cost and subtract your salvage value, and that's the amount that you have to depreciate over the life of the asset. So the useful life of a plant asset is the length of time it is productively used in a company's operation. Sometimes it's also called service life. For example, the productive life of a computer can be 8 years or more. Some companies, however, trade in old computers for new ones every 2 years. In this case, these computers have a 2-year useful life, meaning the cost of these computers less the expected trade-in values is charged to depreciation over a 2-year period. So you determine how long you're going to use that computer. If you believe you're only going to use it for 2 years, then you're only going to depreciate it over 2 years. As this says here, there's several things that make the useful life of a plant asset difficult to predict. One is the wear and tear from use in operations. You might be harder on a computer than somebody else's because you use it 16 hours a day. There's also things like inadequacy and obsolescence, which means inadequacy refers to that asset being insufficient to do what you need it to do. Maybe in the beginning it was, but it becomes, after 2 or 3 years, it's no longer able to do it for you. And obsolescence is that it's not useful in producing those goods or services anymore. That particular piece of equipment has become obsolete in the industry. So you usually dispose of it, and you may be able to get some money for it at that particular point in time. Obviously, if you've had experience with that kind of equipment before, you have a better chance of more closely estimating its useful life. So, Tootsie Roll Company, they have their buildings having useful lives of 20 to 35 years. Their machinery and equipment is 5 to 20 years, depending on what it is. they make a comment here, life expectancy of plant assets is often in the eye of the beholder. So obviously, depending on, your own position as a competitor in an industry, you may have a different way of depreciating things. It depends on what you believe that equipment is going to give you in terms of useful life. So the next step becomes, okay, you know what your useful life, you know what your cost is, you know what your salvage value is, you know what the useful life is, but what method are you going to use to depreciate these items? So we're going to learn in this textbook these types of methods: the straight line method, which is definitely the simplest, the units of production method, and the declining balance method. So the methods are used to allocate the plant assets cost over the accounting periods. So this is what you use to depreciate the particular asset that you're looking at. The most frequently used is the straight line, but we also have these other two that are used in various industries. Alright, so the straight line depreciation method. The reason why it's the simplest is it charges the same amount to each period over the asset's useful life. So we first compute the depreciable cost of the asset. Remember, again, you come up with this by saying, what is my cost, what is my salvage value, subtract the salvage value from the total cost, and that gives you the depreciable cost, and then you divide that by the number of accounting periods in the asset's useful life. And they show that to you in Exhibit 8.6. Why am I not seeing Exhibit 8.6? Not sure. But anyway, it's in your textbook. Exhibit 8.6. So they give you an example. If this machine is purchased on December 31st, used throughout its predicted useful life of 5 years, the straight line method allocates an equal amount of depreciation to each of those 5 years. So if the salvage value of the machine is $2,500, what is the annual depreciation? You have $10,000 minus $2,500, so you've got $7,500 that you're going to depreciate over 5 years, so $7,500 divided by 5 is $1,500. So you would have $1,500 of depreciation on this one for each of 5 years. Now, this is depreciation expense, and it ends up on your income statement, so it reduces your net income. But on the other side, so you debit depreciation expense and your credit goes to accumulated depreciation. And you may have an accumulated depreciation account for each of your plant assets or for each category of plant assets. So you might have accumulated depreciation machinery, accumulated depreciation buildings, but it's a contra asset account, so it reduces the value of your asset. So the entry here would be a debit to depreciation expense and a credit to accumulated depreciation. So the net balance sheet amount is the asset's book value. So in order to determine the book value of this particular piece of machinery, you take the original cost of the machinery that you posted, $10,000, less accumulated depreciation at a particular point in time. And so the book value on this particular date of this machinery would be $6,400. The book value would decline in this example by $1,800 each year due to depreciation. So every year you're going to do the same entry: depreciation expense, accumulated depreciation. Alright, and this just kind of sums it up right here. Now, another method that can be used is the units of production method. Whereas the straight line method charges an equal amount of the asset's cost to each period. You're going to do something differently with the units of production. They give you examples of how, depending on the industry you're in, that the units of production method might be better than using a straight line method. So under units of production, you charge a varying amount to the expense, to the depreciation expense, depending on the actual usage of that particular piece of equipment. So you have a two-step process. You first have to compute depreciation per unit by subtracting the salvage value from its total cost, which is the same thing we did under the straight line method. But then you divide by the total number of units expected to be produced during its useful life. So you're not doing it by the number of years that you think it's going to be useful, but by the total number of units that you think will be produced. And then, once you know the total number of units, you compute the depreciation expense by multiplying the units actually produced in the period by the depreciation per unit cost that you came up with. All right, they give you examples here based on exhibits that are in your textbook on page, let's see, looks like page 341 and 342. So in this case, they're talking about shoes and the number of shoes that are produced. And let's see here, they calculate that 7,000 shoes are inspected and sold in its first year. They had determined that the per unit depreciation cost was 25 cents. So you have 7,000 units produced in the first year at 25 cents, which gives you a depreciation cost of $17.50. In the second year, they produced 8,000 shoes, so that comes out to $2,000 in depreciation. So when you're using this particular type of method, it's based on the number of units that are produced and the cost per unit that you have calculated. And so to come up with accumulated depreciation, you have to add all the different periods together, and then your book value is going to decline each period, but it's not going to decline at the same amount as it does under straight line. It could be in a varying amount. Okay, here's another example that's given to you here from a timber company. You can look at that on your own. Now, the last method that we're going to talk about is what's called the declining balance method, and it is an accelerated depreciation method. It will yield larger depreciation expenses in the early years and less in the later years. And the most common accelerated depreciation method is this declining balance method, even though there are other ones that are used in accounting. So it is based on a multiple of the straight line rate, and it applies to the asset's beginning of period book value. And often they use something called the double declining balance method, which basically means 2 times the straight line method. So in this example here, you compute the asset's straight line depreciation rate, so you figure out what it would be using the straight line method, and then you double that. And then you compute the depreciation expense by multiplying this rate by the asset's beginning of period book value. So again, they give you another example. If you look at the machine that they talked about in Exhibit 8.5 and apply the double declining balance method, you would come out with what they show you in Exhibit 8.11 on page 343. So first of all, they figure out the straight line method is would yield a 20% depreciation. So if you double that, you get 40%. And so if you take that $10,000 machine that they discussed, you would have, instead of a $2,000 depreciation, you would have a $4,000 depreciation in that first year. So they show you how this would work itself out in Exhibit 8.12 for that particular machine. In the first year, you would have a $4,000 depreciation that you started with $10,000. So that brings the book value down to 6. So in the second year, if you do 40%, 40% of 6,000 would be 2,400. And so at the end of the second year, your book value would only be 3,600. So if you follow that particular chart, you can see how the double declining balance would be carried out over a 5-year period. Now, if you compare these different depreciation methods, you will see that they're different, but at the end of the useful life, you're going to end up with a salvage value of $1,000 for each one of them. So you're depreciating the same amount. You're depreciating $9,000, but in some of the cases, you depreciate more at the beginning. In other cases, your depreciation is more toward the end of the useful life. And the book value of the asset when using straight line is always greater than the book value using double declining balance, except at the beginning and end, where it's going to end up being the same. The straight line yields a steady pattern of depreciation expense, while units of production depends on the number of units produced, and the double declining is going to give you a varying amount of depreciation, but it's going to be more in the beginning and less at the end. So about 87% of companies use straight line depreciation for plant assets. 4% use units of production and 4% use declining balance. And then another 5% use some type of accelerated method like a double declining balance method. Now, this is important for tax reporting purposes, because if your depreciation expense is higher in the early years, then it means your net income is reduced, which means you may be paying a lower amount in taxes. So a company might be doing that because their goal may be to postpone their tax payments. Eventually, they're not going to have as high a depreciation, so their income's going to be higher, but they could be trying to postpone it by taking the advantage of the higher depreciation in the early years of that particular asset. And this explains why they may end up doing that. They have, the U.S. IRS has come up with some ways to help companies to accelerate their depreciation cost in the early years that they have purchased that equipment, which might help them in terms of their overall bottom line. Now, you also have to deal with partial year depreciation, because you don't necessarily always purchase a plant asset on January 1st. So you may have that piece of equipment for 3 months out of the year or 6 months out of that first year. You don't have it for the whole first year. So you have to take that into account when you're preparing your year-end entries for depreciation. So that's what this section talks about. So you have to record the depreciation for part of the year. Assets purchased on days 1 through 15 are usually recorded as purchased on the first of the month. So you don't try to do it exactly, the exact number of days, but you try to get at least it down to 1 full month. And then if they're purchased on the 16th to the end of the month, you show it as being purchased on the first of the next month. And this gives you an example of how to calculate that first year's depreciation, in this case using straight line depreciation. Now, this is also what happens if you have to dispose of an asset in the middle of a month, in the middle of a year. How do you go about calculating that? It's the same thing. You just have to determine, in this case, it's 6 months of depreciation. 6 months is, in this case, $900. Another thing that may come up is that over the course of owning that asset, especially in assets that you might have for 20 years, a company may realize that something that they originally thought they were going to depreciate over 15 years has to be changed. They have to make a change in their estimate of the useful life of that particular asset. or that the salvage value has changed tremendously, so they have to make a change in their accounting. So you now have to use the new estimate to compute depreciation for the current period and future periods. So you have to revise the depreciation expense computation by spreading the cost yet to be depreciated over the remaining useful life. And then you do this for all depreciation methods. So remaining depreciable cost equals the book value at that point in time, less the revised salvage value at the point of revision. And this explains an example of how that it applies to an actual situation. And you don't have to go back and restate the prior year's financial statements because it's assumed that you used the best available information at that time to do it correctly. But revising an estimate of the useful life or salvage value of a plant asset is referred to as a change in an accounting estimate. And it's going to be reflected in our current financial statements and our future financial statements, but not in the prior statements. Now you will have to disclose it in your financial statements and explain why you made this change. And that's just part of the full disclosure principle in accounting. Now, both the cost and the accumulated depreciation is reported on the balance sheet or in its notes. So you have your office equipment, your shop and track equipment, all this stuff here is at cost. And then in this account you have less accumulated depreciation. So this shows you what your book value is now. But you don't just subtract it from up here. You list the accumulated depreciation in its own account on the balance sheet. Now this is going to give you an example of Apple and how they go about doing things. And some companies use a record for each asset showing its cost and depreciation to date, and that is kind of like a subsidiary ledger. Not everybody does that, but some companies do. And why you might go about doing these things and what you can learn as a user of financial information by looking at different companies' financial statements and how to compare those. This is what this is talked about here. I'll let you read this on your own. This part about impairment is important, but it's more for an advanced accounting class, so at this point we're not going to worry too much about it, but you can read this for your own benefit. As we've said before, accumulated depreciation is a contra asset account, so it has a credit balance because it's reflecting an amount that takes away from the amount of those plant assets that it's next to. Alright, this just gives you a situation that you can read, and then you can look up the answer on page 360 to see what you think. And then the same thing here. There's 4 more quick check answers or questions here that you can check for yourself and see how you've understood the material thus far.